Good morning, everybody, and welcome to the latest Urban Living webinar. Um, it's Halloween, so we've made a minor concession to that with a spooky little graphic in the corner there. Other than that, it's going to be a pretty serious session, and we are going to take a deep dive into the living sector investment landscape. My name's George Sell. I'm editor of Urban Living News, and we are a B2B multimedia platform for the living and flex workspace sectors. Today's webinar is going to last an hour. We're going to have around 45 or 50 minutes of panel discussion with our industry experts. We'd like to make it interactive, so if you have any questions, please do submit them using either the Q&A function or the chat function in Zoom. Excuse me, and we'll either get around to answering them there and then, or we'll save a bit of time at the end of the session. Everybody who's registered for the webinar will receive an email in the next couple of days with a link to a recording. And we are also trialing a new initiative this week. We're going to include an AI-generated summary of the session. So you can take some notes, but we will also be doing it for you with the power of AI, and you'll receive that with an email as well. Finally, there'll be a quick survey at the end of the session, and we're very grateful if you'd fill that out. It just gives us some idea of what the audience is thinking, what they want to hear about in terms of future webinars, topics, and so on. So before we meet our speakers, I just wanted to show a couple of slides for context, just some of the stories and topics that we're going to be discussing today. These are all screen grabs from our Urban Living News website. Sadly, Ollie from Roundhill can't join us today, but this slide was just to show that we are right on the money with people who are active in the market, because all these screen grabs are all from the last few months, just to show that the likes of Roundhill and Landmark and Brookfield, who are joining us today, are active in the space and really at the cutting edge of what's happening. If we go to the next slide, you can see that the types of investor in the living sector currently is pretty broad. We've got a Singaporean investor in the shape of Far East Orchard investing in homes for students. We've got Lloyds Living, which is obviously the build-to-rent arm of Lloyds Banking Group. And then if we move on to the next slide, we've got private equity. We've got institutional investors from around the world getting involved here in the UK and Europe. So there's a lot going on. There's quite a broad investor profile. And we are going to meet our panelists now and then take a real deep dive into what's actually happening in the market. So, gents, I'd like to ask you to introduce yourselves in turn, and we'll go from left to right as we see on the screen there. So first of all, Chris, good morning to you.
Good morning. Thank you very much for having us, first and foremost. I'm Chris Theodosiou. I'm a partner within the resident valuation team at Allsops. I've been at Allsops now for 4 years tomorrow, actually. I was previously at Sousa for nearly 9 years before moving across. My predominant focus is on bank lending valuation work. I specialize in developments and investments within that. And one of my specific niche valuation specialisms is the co-living sector, which I've been involved in undertaking valuations since its kind of initiation. That was with the Collective and Old Oak originally back in 2016.
Excellent. Thanks for joining us, Chris. Ioannis, welcome to you.
Good morning, everybody. Ioannis Verdelis, for investment and development at Landmark Properties. Landmark's a fairly new entrant in the UK and European market, but we are the largest developer operator of student housing in the United States, with 72,000 beds under management, and recently and increasingly excited about the prospects of the sector here in Europe.
Thank you, Ioannis. And last but not least, Pedro, good morning to you.
Hi, good morning. Good morning, everyone. And well, first of all, thank you so much for the invite. Always a pleasure speaking with you and Ioannis, someone I've met for quite some time, and Chris, nice to meet you. My name is Pedro Sousa. I'm a senior vice president at Brookfield Asset Management, and I cover the living space. That means everything that has a bed and is not a hotel. And therefore, within Brookfield, I do look into the traditional, residential BTR, PRS, but also on the alternative residential, which we called for student housing, co-living, senior housing. And I've been with Brookfield for now 6 years. And yeah, we are quite keen on the sector and been expanding and hopefully to do much more in the next couple of months.
Thank you, Pedro. If you look in the chat, you can see a link to the LinkedIn profiles of our speakers. So if you want to continue the conversation with them after the session, then please do make contact. Okay, let's start by painting a kind of broad brush picture of investor sentiment to the various living sector asset classes, because I think particularly in the last year or so, there has been a shift between the most attractive and the least attractive asset classes. There's definitely movement happening. It's not the same as it was this time last year or a couple of years ago. So we'll kick off with build to rent and multifamily, which I think is one that has definitely decreased in popularity because of the viability issues surrounding it. So Pedro, let me start with you. How would you define investor sentiment towards multifamily, and what are the main challenges and opportunities around investing in it?
Yeah, absolutely. Look, it's a great sector. There are a lot of constraints, especially on creating new product, from planning, construction costs, which have been, probably the two biggest factors to make it very difficult for people to develop. Also, the lending landscape is getting better, but it's not as cheap as it has been in the past. So it's also a small constraint. And when you take all that and you look at how much you need to charge for your rent to make it work, it starts to get into a kind of a difficult place. So I think that's probably why it has been a little bit less in people's demand lately. For us, it's been extremely difficult to play on this subsector, and returns. It's usually where we the reason why we cannot do it. We are in the private equity sector, have a relatively high cost of capital, and therefore we need everything to stack up pretty nice for us to be able to take big views. Now, having said that, everything else is there. The demand pool is growing and is very solid. I think everything that's put on the market is taken up quite rapidly at good rates, and it is something that we don't see changing anytime soon. Although wider population growth is not eye-watering in terms of percentages around UK and Europe, but the reality is the household number are growing. If you think about a couple of years ago, everyone that think about grandparents and etc. would have larger houses, a lot of big families, couple of need for a couple of rooms. Fast forward to today, in average people don't actually have even 2 kids. So the demand for households is completely different. And I think historically we haven't changed much the way we've built. And I think now everyone has a good view that the traditional just building they will come is still okay, but is not as true as it has been before. And I think that's where the BTR has been still there, but there's also a lot of demand for alternative residentials, and that's just because people understand that as the society evolves and we have different ways to occupy spaces and and live in spaces, there is room for a couple of other type of residentials that are kind of in big demand, but I think there will be even more as we get used to it. And I'm talking about student housing, I'm talking about co-living, and also the senior housing, which in Europe is quite nascent. When I'm talking about senior housing, I'm not talking about care. I'm talking about student housing for older people, and that is something that exists a lot in US and Australia. I think in Europe we're not there yet, but there is a huge opportunity because demographics play in favor. So I think it's not that ETR and normal PRS are not great places to invest, but there are more places, more ways to have exposure to residential, to proxy investments, which are often more operationally intensive and therefore yield slightly higher than normal BTR, and also are in the forefront of creating new products, which, I'm speaking for myself, but I think for everyone in this panel, it's very exciting to be, thinking about the next generation of living in Europe.
Pedro, just sticking with you for a minute. What about single family rentals? I mean, specifically in the UK, it seems to be attracting a lot of investment, partly because multifamily is a challenge, but also because the demand is still there. The house builders seem to have got their head in the game now and are, quite used to selling off chunks of inventory to investors for single family. Is that something that Brookfield is getting involved in?
Yeah, we're looking at a couple of things. We haven't found yet, the right opportunity for us, but it's something we're quite keen. We like it. All the fundamentals. It's also true, works really well in the UK. We've looked at also in continental Europe, different way of looking at housing, and there we think there is an opportunity in very specific markets or sub-markets, but it's not as wide as in the UK, because I think just the way people look at residential is not the same. So, in the UK, I think it's pretty common for people at certain point wanting to move into a townhouse, sort of, individual single family. I think in continental Europe, that is not as much. And, people would be very happy to live in a 3-bed or 4-bedroom apartment in city centers, and there's a couple of them. So it is a slightly different approach. We like it in the UK. In Europe, only certain segments or sub-markets, but we haven't found a way to make it at scale and with the profitability we need, because that's also a big problem for us, is we do need scale whenever we do something, and often what we've seen is a lot of these projects are just too small and not easy to replicate. So if we don't have security that we can start with a small portfolio but make it bigger, then we are not as excited with the opportunity. Having said that, I do think it's a quite interesting opportunity in the market right now.
Yeah, thanks, Pedro. Ioannis, let's come to you and talk about PBSA. Been loads of activity the last 2 or 3 months. A lot of transactions, some new players in the market in Europe here, including yourselves with your first couple of schemes that you've announced. Tell us a bit about why Landmark decided to get involved in Europe, and what are the main challenges and opportunities you're dealing with in growing your portfolio, because you're pretty ambitious. You're looking to go from 0 to 60 pretty fast, aren't you?
Yeah, I mean, look, for us, it's partially a story of market, partially a story of Landmark specific. We've grown to a very substantial player in our home market in the States. We've been looking at Europe for some time, and the UK for some time now. We looked at it before COVID, then COVID hit, then we sort of took a step back as we would. We perceived the market to be a little bit too frothy coming out of COVID, and the truth is the market is pretty difficult to make development work in the UK, particularly at the moment in PBSA, which for us is an opportunity. We think there's not going to be very many developments coming through in the next few years from a variety of reasons: viability, people stepping back, planning. And that's an opportunity for us to take some market share in the current conditions, acquire plots or schemes in locations where perhaps in other different market conditions we wouldn't have had the opportunity to. So, I guess our move is not is a sign of confidence in the medium-term prospects of the market, but also of a recognition that the short-term challenges of the market present an opportunity for us specifically. It's not because we think right now is an easy moment to do it. It's quite the opposite. We think it's quite a hard moment to do it for a lot of people, and we're we're of the strength and size to be able to navigate that and take the medium-term view.
Yeah, thanks, Ioannis. Chris, coming to you, let's talk co-living. You've kind of been around the co-living scene more or less from the start. You've got a lot of experience in it, but it's still a nascent sector, and there is a fair bit of investor interest in it now. How are you seeing investor interest change, and what effect is that having on the kind of product that's being delivered?
Yeah, so, like we've seen it over the years with the co-living products. It started to change from its initial early adaptation in terms of what the offering was. Okay, how is it then changing to help from the operations side to reduce costs, to maximize your NOIs? And then investor appetite has changed as well. And we initially saw some increased demand, and then obviously the kind of stigma that surrounded the collective and what happened there was a little bit of negative press, you'd say, in some senses. But the last 2-3 years, we're definitely seeing a lot more demand from it for investors. The biggest issue is actually seeing trades, but when it's an asset class which is still in its infancy and there's not many stabilized assets there available to trade, it does hinder the market. So until we start to have more developments coming through the pipeline and actually completing to then allow for investors to acquire, we will still see a slightly reserved perception of it. Obviously, the forward funds that have happened over the last couple of years are definitely helping that and showing some traction there. And we do have some institutional capital who are seriously considering some assets across the marketplace at the moment. It comes back to viability, and we do have substantial viabilities at the issues at the moment across all of those remits in terms of build to rent, student, co-living. Obviously, single family is probably where the demand currently is because of some of the lack of regulations from BSR to make that compliant, to get that through and started on site. So that is part of a hindrance on some of the sites that we're seeing coming forward, but it's not just co-living sector as a whole, it's the living sector entirely.
Yeah, and as a valuer, Chris, presumably co-living is slightly problematic. As you say, there haven't been too many transactions, so valuing assets it makes life a bit harder. What's the kind of situation there?
It is difficult on that part. Obviously, having been involved since its early adaptation, I've got some very good contacts and some great insight into the deals that have happened. And there are deals that have happened. It's just understanding what are the nuances of those deals, what are the key characteristics which the investors were looking at, and why they were then paying those rates and levels that they were. That for me is kind of the fundamentals of what I have to get back to and kind of break back to understand each scheme and each comparable from that perspective. Regionally, it's a lot harder than it is in London because ultimately investor demand at the moment is more focused London ways for co-living. Regionally, it's making sure it's underpinned, and there's substantial demand from the student market as well as a fallback position. And at the moment, we are seeing as student being the underpinning for both rentals and potential yields for co-living in the regions.
Yeah, thanks, Chris. Pedro, did you want to come in on that point?
Yes, just maybe just a quick question, if I may, to Chris, is and just very curious, as the co-living environment changed, right? We all remember the first co-living schemes were, I don't know, 14 square meters, very small units, and then big common areas, etc. But to a point where I think we are now, the new co-living new generation, which is almost like a studio-led multifamily, in a sense that you don't have the 14 square meter rooms, you actually have 20, sometimes 20 plus, or even those studios that are configured almost as a one bedroom, although there's not really walls to consider it a one bedroom, so higher. And does that change the way, Chris, you value the co-living? So from the layout, does it impact much the value, the intrinsic value of the asset, or is still quite one label and everything kind of fits?
No, it's definitely not one size fits all in this sense. Yes, we have seen sizes changing quite dramatically. We've seen some schemes now kind of stabilized closer to kind of 19, 20 square meters, as you mentioned. And we're seeing institutional appetite actually looking at potentially pushing that slightly further, potentially 22 square meters as an average. And the view on that is actually future-proofing the assets themselves from a demand perspective. I kind of agree with you. We are now starting to go into a micro studio multi-family rental model, and I don't think it will be too long until we do see a multi-family scheme which has got traditional build to rent alongside co-living. The big thing in terms of the unit sizes is longevity of stay from tenants now, which is one of the key things which we're seeing. So it's not being considered as much of a transient tenant position, and there is longer stays. So average length of stays at the moment across London is about 15 months, which is great to see from tenants. And then also larger unit sizes will demand a premium.
Yeah, thanks, Chris. Ioannis, you've just raised an interesting question in the chat there, which is how much of the demand for build to rent and co-living indeed is generated by a student audience. Chris, do you want to have a stab at that first on the co-living side, and then maybe I'll come to Pedro on the multifamily side?
Yeah, from a rental perspective, actually, co-living in London, they're trying to veer away from students. And they're only looking to potentially have up to kind of 15-20% maximum students on site. And the main reason for that is the ethos and kind of community atmosphere which co-living products are trying to build for their residents. And having too many students in there does then tend to make it like a student block. So yeah, there is trying to be a limitation from operators here in London. Regionally, it's being a little bit more underpinned by the student market until it's understood as an asset class on what it's offering.
Yeah, I think there's a similar situation with build to rent. I do know of some London buildings that are capping their rates at maybe 25, 30%, but perhaps a bit higher than what you said, Chris. But Pedro, have you got any experience of that in your build to rent assets?
Yeah, we do that in our, so we have within Canary Wharf Group, we have a Virtus, which is a build to rent brand, and we do cap the number of students that we allow in the scheme, just to create, not to go straight to student macro student housing, but to create the spirit of community, longevity, long-term approach to the property, and and make sure that's the right environment for the right building. Not that we're against students, we love them, but it's just there is, and I think it was mentioned here, somehow sometimes a blur between co-living to student to BTR, and although I think, to even what Chris was mentioning, there is a trend to go into more all-encompassing properties. Often you don't want also to create a situation where some people, when we target more premium kind of rates and more premium living, and then you fill it with students, and then the environment is not quite right for what you want to create. And that's just fair. I think everyone needs to understand what is the demand they want for the building they've built, and try to manage that.
Yeah, thanks, Pedro. Chris, did you want to come in on that?
Yeah, just another little point to add. From the co-living perspective, currently at the moment, Verbalife have recently done a study, who are the largest single operators in co-living here in London at the moment, and they've done a study, and average age of their tenants is about 31. Over 25% of their tenants are actually over 40. So as much as co-living is always kind of perceived to be that young professional, tenant demographic isn't currently showing that.
Yeah, interesting. Thanks, Chris. Pedro, just quickly, I want to talk about later living. We won't dwell on it, but in terms of the supply and demand fundamentals, it's the most compelling subsector of living. The demographics are incredible, but we're not really delivering anywhere near the numbers that we need to in terms of market penetration. There have been a couple of institutional investors who have gone for it big time, but still quite a bit of reticence out there. Why is it such a difficult sector and a difficult product to make it work, do you think?
Yeah, well, I don't have the solution. I wish I had, or I can give you my view. Look, on paper, it's probably the best strategy to invest right now. It makes all the sense. All the numbers stack up. I think culturally, and you cannot see that easily on paper, it is a completely different situation. And look, I think there is, contrary to the US, where retirement communities are a thing and everyone knows what they are, and they're pretty common. I think in Europe, and it's also different. There's not one Europe. There's Southern Europe, Northern Europe, UK. It's all of them have their own nuances and different way to approach senior living. And I would say that it's still a big stigma on people to decide to move to a place like this. And look, it's understandable, right? They're older adults, but they're healthy. They feel strong. They don't know why they would leave their current place, even if sometimes it's oversized, and they also have sometimes a lot of equity stuck there. So why would they leave that place and just go to a smaller apartment with only people of their age? I think there is a path to, maybe the solution is more of a multi-generational schemes that then led to somehow a more senior-led kind of complex. Maybe that's the strategy. Maybe is creating products that fit in a more active part of life than just thinking about care and about what services would you put to older people. But reality is, in senior housing in Europe, if you take out care, the average age starts with an 8. So and it is quite difficult to change that mindset. In other countries, that on other parts of the world, that number is slightly lower, and I think that creates more of an opportunity. So I think it is cultural. It will take time. I think we will get there, and especially where the people that grew up already knowing what renting is, what BTR is, what student housing is, and whatever. There will be a moment that they will know that there is a type of product that will suit their lifestyle much better than what they have, and that will be easy. But we're still far away from that in terms of number of years. So I think somewhere in the middle, we should find a way to restructure that market and create a product that actually people look into it and say, hey, this actually makes a lot of sense. I should give it a look. And there are a lot of models on senior housing. We like the rental model more than anything else. It's just simpler. Don't make people putting a lot of equity, at later life, stuck in an asset. So I think it's more flexible and people like it. But in any case, it is a cultural topic that I don't think we are there yet, but a lot of people are spending a lot of time trying to break it, and someone will for sure.
Yeah. The multi-generational thing is really interesting, and picking up on your point, Chris, of having co-living and build to rent in the same building. I think the utopia for living sector investors and operators is to have one of these multi-use buildings where, according to your life stage, you might be on a different floor of the same building, but a lot of the operational synergies would be there, the facilities would be there.
It'd be fantastic for some developers or operators to have your tenants just transition from block to block throughout their lifetime.
Yeah. Well, what
a lifetime subscription.
Yeah.
Why even move blocks? Just have move floor in the same building. One of these vertical villages we hear about. I'm sure it will happen. A little way off yet. Chris, let me stay with you for a minute. Let's talk about appetite for development versus acquisition at the moment. Is it, with all the challenges around planning, Building Safety Act and so on, development costs, is it more compelling to acquire existing stabilized assets or to commit to new development, do you find at the moment?
You've probably got pros and cons on both fronts, I'd say. Current appetite, we are seeing more for stabilized assets just because of risk profiles associated with developments in general. Build to sell, especially, we're seeing a lot less activity at the moment. Vendor expectations over the last 2-3 years has been quite different on that front in terms of where the marketplace actually is for land. We are starting to see a bit of a shift in that part, and vendors have come to some realization on that where their sites are currently valued against what they're wanting are slightly getting closer together, but still limited activity there because the build to sell market has got limited exit positions and people have got uncertainty surrounding that. From a rental and investment perspective as well with these kind of developments, it's, I'd say, other government impacts which are kind of influencing things and restricting demand. Gateway is a big factor at the moment across all developments.
Yeah.
I think it's something which we obviously need to have regulations there, but it's the process of these regulations and how they're implemented for developers. It feels like it's something which was slightly premature and rushed in terms of the process of it, and now it's causing substantial delays for some. We've looked at some sites where we're now having to allow for between 12 to 15 months pre-construction just to allow for Gateway 2, 3 months on the back end. It's that additional uncertainty. What if you're doing a student block and you don't PC in time for that graduate year intake? You then have pretty much a vacant asset for nearly 12 months. If you're a debt funder on that, what's your stance? It does restrict where their appetite's coming from. Stabilized assets are slightly different. It's where are yield profiles today, and are vendors again willing to dispose of an asset at probably a slightly softer yield than where they booked it 3-4 years ago, just because of where the market's gone today. And best in class, yes, they're trading very strong when they do trade, but again, institutional investors who own those don't want to dispose of those currently. So again, slightly restricting in terms of availability of what there is there in the marketplace to buy at the moment.
Yeah. Well, Ioannis, you've heard from Chris there, so some of the delights that are awaiting you on your expansion plans. Why have you, I mean, you've initially chosen to go down the development route. Can you tell us why that is, and are you also looking at acquiring existing assets?
Yeah, we're not against acquisitions. So the quote that my US colleague says, in Europe, everything seems to take twice as long and cost twice as much in terms of development. And to be honest, it is taking twice as long and it's costing twice as much than I was used to 3 or 4 years ago. So I think development is really tough. Timescales are very long. The land market hasn't really repriced. Maybe it has in some places. Some vendors are readjusting expectations, but there is it's taking some time for that to happen. So I think development is hard. In terms of acquisitions, I think the challenge is finding something of institutional quality and good assets to trade. And if there are some, that's great. But then you have, a variety of issues to contend with there. You have fire remedials and fire safety. You have which affect most of the things that are out there. And you have the fact that, at least in the student market, the leasing story hasn't been as strong for the last 2 years. So you need to be quite selective with where you develop and where you acquire, if you choose to acquire. So for us, we do see it as an opportunity to develop in locations where others are pulling back now. So we're getting some good kind of opportunity if we can navigate the time it takes. And in terms of acquisitions, yeah, we'd look at things of the right quality and at the right price if they exist. It's just, I think the market has had a sort of a massive change in terms of timescales, in terms of construction costs, in terms of finance. Those have all happened over the last 2 years, and I think the market is trying to find where it is in terms of pricing, both in terms of land and assets to be traded, etc. I'm talking about the UK. I think it's a slightly different story in Europe, where I know Pedro has had some transactions too. So yeah, so I think in the UK, my interpretation is, yeah, it is hard. That does create opportunity. That does make your job hard. And if I look at the medium term again, I think that will mean fewer deliveries every year from here on for the next few years. In fact, for some years, I think just because the gateway was introduced all of a sudden, you end up having some zeros there, right? Because as these things were introduced, they all added about a year to the pre-development timeframes, and everybody will be in some kind of a process of planning or gateway. So there will be, my view of if you're starting development now is the one thing to look forward to is you'll be landing these developments into operational phase in a market that won't have seen a lot of stuff being delivered between now and then, to be honest.
Yeah, thanks, Ioannis. Chris, how is all this uncertainty affecting lender sentiment and lending activity across the living sectors? I mean, are investors and developers having to put a bit more skin in the game? Are LTVs changing? What's the kind of picture there?
LTVs aren't really changing, but yes, there is having to be some more equity put in, especially development-wise. Now funding Gateway Design 3 and 4, going through Gateway 2 prior to putting a spade in the ground. That's obviously having some challenges there. In terms of LTVs, lenders have still got quite a lot of appetite. Again, it's just very selective in terms of locality for these assets and assets specifically. The student kind of development market, as I mentioned before, lenders are now looking for development to kind of PC potentially March, April time. Hopefully there's not any delays and then that Gateway 3 back end to miss that intake. So they are being selective. They're being quite specific in terms of what they want, what they're looking for and requirements as well. From that side of things, you'd say interest rates have had substantial impacts and a change over the last few years, but we are starting to see quite a lot of competitions from lenders, and appetite there is driving that really, with limited availability of good quality stock for them to lend against.
Yeah, thanks, Chris. We've got some questions coming in from the audience, which we'll get around to answering shortly. But first, Pedro, I want to ask you about the kind of OpCo-PropCo structure. Brookfield is a fan of acquiring assets and operating platforms. Do you want to talk a bit about the kind of rationale behind that?
Yeah, that's true. It's as our DNA, we've always been operators in whatever industry we act, that being infrastructure, private equity, real estate, and it has worked well for us traditionally. The rationale behind it is control over the product you deliver. So we like to be from often early start development to onboarding the properties to then making sure that the operations go as we believe they should go, or run as we believe they should be run. And the upside of having the fully vertical structure is that it's not a negotiation with a third party, or should we do this or should we do that, can we look into this. It is our business, so everyone is acting on the same manner to try to maximize value on this kind of vertical, and that usually helps, and that makes us very flexible. So we know if we need to change rents in the middle of a sales period, we can do it in minutes. If we need to change operations, hire more people, streamline head services, takeout services, we can do it, I would say not in a day, but very quickly. And that is all streamlined. All the contracts are, within our standard of contracts, which also often allows us to do macro contracts, because we do manage a lot of platforms, and we can actually go and say, look, we don't have one, we have 10, and we control the contracts on all these 10 platforms. So let's just sit and discuss how we can, have a contract from a supplier that works for you, but also works for us, and everyone wins. So this kind of mindset, it's only possible if everything is run through your ownership. And therefore, we've been, quite happy and quite eager to do that. It is quite painful, especially on the first couple of years of each platform. It takes a lot of work, a lot of time, a lot of investment on making it work. But once you stabilize, and I think there's a point, we do this because we usually try to scale businesses to a point where this makes sense, right? The the rationale will not be the same if you own 2 or 3 assets, or just pockets of assets in different countries. I think there are great operators, great third parties that do an amazing job, and that's probably the best solution. But at a certain scale, internalizing and having control over operations usually allows us to deliver, I'm not saying is a better product for the end user, but at least is the product that you believe you should be delivering for the assets you have. And that kind of match between product and offer, it's often the difficult part to get it right. And if you control the operations, you should get it right.
Yeah.
Theoretically.
Yeah. Thanks, Pedro. Ioannis, what's your strategy? Are you going to manage your assets in Europe, or will you appoint a third party?
The first development that we've announced in London that you put on your screen earlier, that's with a partner who have their own operational platform in the UK. So that will be done through them. In the US, we are a fully vertically integrated business. We have our own property management, asset management activities. We even have our own general contractor. We're actually one of, if not the largest general contractor building student housing in the States, just building our own stock. So, naturally we tend towards integrating everything within the group, but we're also recognizing, you're asking me about something that we just talked about, how long it takes to develop anything. You're asking me about something that will be years before we have to worry about it. And the market is changing quite a lot. So, intention is that eventually we will be vertically integrated here too, fully. Which parts of that integration happen at what point is the thing that we need to decide, depending on deal flow and at the right time. We've obviously got a lot of capability to operate a lot of beds already as a group, not in Europe, but technology, structures, processes, we're pretty good at it. So I hope we do it here. We're also looking at UK today, but eventually beyond into continental Europe in terms of our strategy. So it's a pan-European strategy we're launching, not a UK-only strategy over time. So again, we're starting from the UK, we'll go beyond, and that will also impact on our decision making. Some of these markets have more depth of supply in terms of good operators to manage your scheme than others.
Yeah, thank you, Ioannis. Okay, let's go to audience questions. We've got a few here, and actually 3 of them are all asking about the renters' rights bill and how that's going to affect the various different asset classes. Chris, a couple of people asking how it's going to affect co-living and whether it will have an impact on the tenure of the occupants in co-living. What's your take on that?
Co-living is still trying to move to a longer stay model. There's a lot more 8, 10, 12-month stays rather than there are 3-4 month stays. I think it's going to be quite challenging for the shorter stay operators. Ultimately, those institutionals which are looking to have the longer term lets already there and in place, for them, I don't think there's going to be as much of an impact. Ultimately, the grounds of eviction is potentially going to be troublesome for co-living assets, with kind of the community impact it's meant to drive and create with the tenants there, but whether or not that would be a potential reason or ground of eviction to be seen, whether or not operators are implementing that is what I mean, sorry. But ultimately, I don't think it's going to have as big of an impact as people are perceiving it to have.
Yeah, interesting. Thanks, Chris. Another question here from Volodymyr, and I'll aim this one at you, Ioannis. Do you think students will now be more keen to consider the private rented sector versus PBSA as a result of the Renters' Rights Bill?
I mean, this renters' rights is the biggest discussion. I was yesterday just typing a huge note on it. I was on a train, and the other 3 people on the carriers were talking about renters' rights. So it's going to have a massive impact on a lot of stuff. I think I disagree that it's going to have a minor impact. For the student market, I think We have seen the last couple of years the BTR market in particular, and co-living to a lesser extent, being a relevant player in PBSA, as it were. So we used to kind of count how many students we've got and how many student beds we've got, and that was that. Now, I think in certain, what has happened is the PBSA rents have gone up over the last few years quite a lot. The utility costs have receded over the last 12 months. Suddenly, BTR in certain cities is a very relevant value proposition if you're a student. So I think the students are already looking at co-living and BTR and have done for the last 2 years, increasingly so. What I don't know is how BTR players will see students, because for the last couple of years, students have been a great source of demand for a lot of BTR schemes, particularly during stabilization period or beyond. Now the students will be able to move into your BTR, but also give you notice that they want to leave in June. And so suddenly you have this to think about as an operator or as an owner of BTR. So in some way, I think it makes BTR and co-living attractive for students. At another level, I think the institutional BTR and co-living might see the students with more suspicion. Previously, they were just the guys who paid the most rent. So
Yeah.
So I think those two things might balance out a little bit. We're of course also yet to see how all the PBSA exemption, etc., will manifest in practice, and how the various codes will be applied in practice.
Yeah.
A lot to kind of. Only 3 days old, the legislation, and specifically for students, the provisions aren't really clear for another few months yet.
Yeah, well, going back to your point of everything taking longer than it should, we originally had a webinar scheduled for 2 weeks' time called the Renters' Rights Bill, the impact so far, because we were expecting it to be, all in place and all affecting the market several months ago. But we will be doing that topic in the new year, so we'll talk about what effects it's actually had. Next question I'm going to direct to you, Chris. It's from Steve Omenyondo. He asks, on the BTR side and in particular London, do panelists have any concerns regarding affordability? Some of the major research firms have downgraded their rent forecasts in the last year, citing depressed real wage increases.
I mean, across London, you always have concerns about affordability. When I'm looking at some of these co-living schemes and I'm seeing the rents being achieved, I think it's astronomical that some people can afford to pay these. We're talking most co-living schemes now across London are kind of in and around the £2,000 a month mark. Yes, all inclusive, but still quite a vast sum of money for 17, 18 square meters. Is that going to change in the near future? Are we going to see a potentially build to rent and co-living schemes being more affordable? Probably not, because ultimately from a institutional investor perspective and actually viability perspective as well, given where build costs are, where finance costs are, it's not viable to build these schemes out and have them capped at affordable rentals. We've seen in the past some discount market rent units being allocated within schemes. So DTZI across a couple of their co-living schemes have DMR units, but the private rented assets, they are still quite high levels. I think the last 2 years specifically, we've kind of, or the last 12 months anyway, actually, we have seen double digits on rental increases and rental growth. But that is definitely coming off. And I think that is also part of the perception in terms of why forecasts have been downgraded in some senses. It is where the market is going, but again, it's having consideration to any cash flow models, what inputs and assumptions you're making and allowing for your growth rates, and it's just making sure you have some consideration and caution to it.
Yeah, I do think we're going to see less amenitized product coming forward, both in build to rent and PBSA, which in theory will lead to slightly lower rents. But yeah, I think the days of super over-speccing your development to compete with the competition is probably over now. It'd be interesting to see how that plays out. Next question is for you, Pedro. You're definitely in the box seat for this one. From Nicholas Dugadil. He's asking, what are the most attractive markets for flex living and PBSA in Europe?
Well, PBSA, well, there are two that are automatically answered, which is France and Germany, just because they're the biggest student markets in Europe. I think the number of students actually bigger than UK. Now, that doesn't mean that it's an easier market. There are very tough markets to get in. The structure of the market is completely different. It's much more closed. Now, having said that, it has a lot of students, but is less number of international students, which also, to the point on the product you deliver, needs to be adapted to that. So, and maybe to Steve's comment, affordability is also a big topic, right? So, I hear a lot of developers, especially in London, then you look at their schemes and they're just basically internationals and 2 or 3 markets really paying super premium rents. In continental Europe, your view needs to be slightly different. You can rely a lot on international students, but they will be from different markets and often not paying this kind of super premium rent that you see in London specifically. So as long as you have that in mind, you do have a very healthy student markets in Europe. So those two for sure are markets that anyone that wants to have a big footprint in Europe needs to tackle in. And then more niche markets, let's call it Italy, for sure is one that everyone wants to do it. It's extremely complicated to develop in Italy. There's no product at all. So a lot of people have been rushing there, and it is the first assets that have been delivered are extremely high rent, extremely good quality, but there is a space for sure for something more mass market. And finally, we've took a view in the Nordics recently for that same exactly situation. It is a mix between PBSA and flex living that we are trying to build in the region. And the reason is also the same, except for a little bit in Denmark. There's no product anywhere in the Nordics like this. So for us, it is a market worth exploring.
Thanks, Pedro. Ioannis, how about you? You obviously you have plans for the European market as well as the UK, having secured some sites here. Which other markets are you looking at?
We're studying a variety of European markets. I wouldn't want to confirm where we're going next, but the reason we started from the UK is that we think it's the most the largest size market and the most institutional in terms of transactability, risk, and sort of ability to deploy capital in the first instance. But Spain has seen a lot of activity, obviously, in the student market recently. I think there's other markets like Germany that for a while weren't viable are becoming more viable now. So what we will do is over the next month select which one is the next one and then redouble our efforts there. So we're not sort of going to go and do a lot of markets all at the same time. We're going to pick another hub and go from there.
Playing your cards close to your chest there, Ioannis. We'll have to watch this space.
I want to take where we're going.
Okay, it's nearly 12 o'clock, everybody. This is flown by, this session. Thanks everybody for your input and thanks to the audience for the questions. Just going to show a few slides before we close up. So our next webinar, which will be on the 28th of November, is about the future of build to rent. We've alluded to it in this session. There are some quite significant challenges affecting the market, which are determining strategies in terms of what people are building, what people are prepared to invest in. There's a lot going on. So the link to register for that one is in the chat. Hope to see plenty of you there. If you'd like to work with us at Urban Living News, whether on our digital offer, in-person events, do get in touch with my colleague Sam, whose contact details you can see on the screen and also in the chat. And finally, thanks everybody for watching. Thanks ever so much to Chris, to Pedro, and to Ioannis for their great insights. Thanks to those who submitted questions. Thanks to you all for joining. Give us a follow on the social channels you can see on there. and have a great weekend. I'll see you on another webinar soon. Take care, everybody. Bye-bye.
Thank you, everyone.
Thanks, everyone.
At IHM, we believe in the power of connection. We exist to inspire, to inform, and to unite decision makers who are shaping the future of hospitality and real estate. Our why is simple. We believe this industry thrives when people and ideas come together. And we're here to make that happen. So how do we do it? We challenge the status quo by creating platforms that go beyond the expected. We blend intelligent content, curated events, and a strong community into everything we do. Making it easy, accessible, and genuinely useful. From online engagement to face-to-face connection, we are known for being insightful, collaborative, and refreshingly human. We publish 4 leading multimedia brands, each a trusted voice in its sector, delivering breaking news, bold opinions, and fresh trends. We host world-class events, panel discussions, podcasts, award ceremonies, and webinars. Designed to spark ideas, drive conversation, and create impact. With over 62,000 monthly web visitors, 55,000 email subscribers, and 69,000 social media connections. Our reach is deep, and our community is active. We're partnered with the biggest names in hospitality, and we'd love to connect with you. So whether you're looking to grow your visibility, meet the right people, or understand where the market's heading, read, watch, listen, and meet. Do it all with IHM.